Hey, dividend investors, bonjour. First, I want to say, and I'm very sorry for the technical problem that we had this afternoon. You were supposed to get this as a live webinar, but unfortunately, Webinar Ninja server kind of died like 5 minutes before I went online. So they had to restart the server. I couldn't log in. You were left in the dark. So long story short, I had to take a quick run to calm myself down because it's quite upsetting. You know, you prepared this presentation and I love to see all the comments and the questions, and it gives me a lot of energy. And I will have to do as you were here with me. Obviously, I will not be answering any questions right now because I was not able to get them up front. So what I will do is next week we'll do a Ask Me Anything webinar. But today I want you to deliver the presentation nonetheless because there's a lot of things happening in the market. I'm pretty sure that you feel a bit alone, a bit confused. Maybe you're afraid of what's happening. You're concerned about your retirement. I know that a lot of people right now are retired or about to retire, and they look at their savings and it's just melting down. And there's a lot of confusion here, lots of contradicting information, and one day the market goes down by 12% and the other day it's up by 5%. And pretty much over the past 3 weeks, we all lost about 30-35% of our portfolio, which hurts a lot. So today you are here to get a clear picture of what's going on right now. Focus back on your strategy. Obviously, you were supposed to get to ask your question and get straight answers. That's going to happen only next week, unfortunately. You are not here to buy or to get buy or sell recommendation. I am not your broker, your personal financial advisor. Therefore, anything that I see or anything that you get from DSR or one of my blog or this webinar cannot be taken as a recommendation. We are not responsible for your losses. Unfortunately, there are a lot right now on the market. But on the good side of things, you won't have to pay me a dime if you're making money. At the end of this presentation, I will also invite you to join the DSR community. So I have a paid membership website that supports investors called Dividend Stocks Rock. However, this presentation, this webinar is not about DSR. It's not about a pitch sell. It's actually about you, about your portfolio and what's going on in the market and how can you improve your portfolio right now, what action that you have to do, and to maybe clear a little bit of the noise, calm yourself down, and look at the market with a fresh new perspective. So for those who don't know me, my name is Mike Héroux. I am French-Canadian living in the beautiful province of Quebec. I've been an investor since 2003, and since then I've been 100% invested in stocks. I got interested into dividend growth stocks starting in 2010 when I bought the Dividend Guide blog. Before that, I was just more like an active trader, buying, selling every 2-3 weeks. I actually built myself enough cash down to buy my first house like this in 2006. I've lived the financial crisis in 2008-2009 as an investor, but also as a certified financial planner. So I was responsible for a book of nearly 400 clients. I was supporting them throughout this journey. I wrote them financial plans, investment plans, and I tried to make sure that they follow it, because the most important thing here is to stick to your investing strategy. I've worked over a decade in the financial industry as both certified financial planner and a private banker, mostly in the investing part or retirement planning. And after a while, what I decided to do is to create Dividend Stocks Rocks. I created it as I was a private banker back in 2013. I was doing basically both things. So I was a private banker at day and DSR founder at night. And then in 2016, I decided to take a break, put my life on pause, and I drove in a small RV with my family that you can see on the picture. So my wife Jose, my 3 children Caleb, William, and Amy. We upped on a small RV and we drove all the way down to Costa Rica. It was a 1-year trip. We spent 7 months in Central America, and that made me realize that what I really want to do in life is to help investors. And as a private banker, I had about 300 clients, which is not much. And now I'm able to help over 1,000 investors. Actually, we're at DSR, we're 1,500 members. So quite a great crowd. It's improving, it's increasing and growing all the time. And what is important to know about myself is basically that I am passionate. I'm passionate about what I do. I'm passionate about my family. I'm passionate about traveling and also obviously about investing. So let me tell you a little bit of story. Every single year I'm super original, and in January, because the holiday season has been very rough on me, too much food, too much wine, and I usually weigh around 200 pounds at that time of the year. So obviously I come to myself, look in the mirror, and I'm a bit discouraged. So I'm like, you know what? I'm gonna lose weight this year. And this year it was quite interesting because for the full month of January I went into Vietnam. So we traveled, we visited plenty of places, we did trekking with the family. It was awesome, and it actually helped me losing weight. So when I came back in February on Monday, I put myself on the scale and I was at 190 pounds. So I'm like, oh, it's good. I mean, you know, I'm already losing 10 pounds after my trip. It's good. Now let's hit it hard, go training, do some shakes, and get in shape. So on Wednesday, I go back on the scale and now I'm at 188. So I'm like, yeah, I mean, it's only 2 pounds, but it's better to lose 2 pounds than to gain, right? So I was quite encouraged and I keep going, you know? So on Friday, I now weighed 180 pounds and I'm like, you know what? After a single week of training and shakes, I lost 10 pounds. So I go back to my computer, pull out an Excel spreadsheet, starting to do graph calculation, look at my training and stuff. And you know what? By the end of the month, I'm pretty sure I will weigh 150 pounds. Yeah, I know, it doesn't make sense, right? I'm not going to lose 10 pounds every single week. Well, you know, this is exactly how the brain is wired to create patterns. And this is exactly what's happening right now with the market. When you look at what's going on, well, it's going down very fast. Oh wait, this one is from 2008. As you can see, both the S&P 500 or the TSX 60, so for both Canadian and US investors, it was just a nightmare. We started the year with great strength, and then at the middle of the year, around July or August, Lehman Brothers went bankrupt, and then everything else went sideways. We lost roughly 40% during those 5 months. It was fast, it was brutal, and it hurt. Now this time, we have the same thing, the same scenario, but it's happening over about 1 month. So let that sink in for a moment. A lot of people are afraid right now, and I get it. If you read financial news, if you read the blogs or social media, lots of people are telling you, this is the end of the stock market. You're going to lose a lot more than 50% of your value. You're likely going to lose 90% of it. It's going to be like the Great Depression. It's kind of like the combination of the Great Depression and the Spanish flu combined together. So if you will either die or you will lose all your money, right? And I totally get it. When we see that on the market, it is frightening. We never saw such a violent movement day after day on the stock market. It was just crazy. Expect a lot more fluctuation. At the time of recording here, we're on Thursday, March 19th. I'm pretty sure that tomorrow we're going to have new surprises. And if you watch that over the weekend or on Monday, we're going to have more surprises. Today, I'm not here to talk about the coronavirus. I'm here to talk about its economic impact. So whether or not you believe it's dangerous, I'll leave that to you. I'll leave that to the specialist. What I have to tell you is it is dangerous for the economy, and it has a real impact right now on the stock market. What you see here is actually kind of funny because this is a graph to explain you how social distancing could smoother down the virus and make sure that our healthcare system takes care of it and less people die. But what's happening on the stock market, it's pretty much like scenario number one. Nothing is done, so there's a lot of volatility and it goes down very, very fast. What's happening here? It's important to understand there are a lot of investors that are making money out of people losing on the stock market. We saw that in 2008, and today it's even more powerful. There are a lot of investment vehicles like options, for example, and you also have a lot of people that are doing short selling or hedge funds manager that are playing with tens of millions of dollars and sometimes even like close to $1 billion in terms of fund. They are playing that on the market against you, against your portfolio. When it goes down, they make money, so they're happy. So what is created in the market is huge market swings because those investment products helps investors to benefit from that situation, but it's pretty much like taking the market and pushing it down the stairs so it goes faster down. So this is what we're living right now. As it wasn't enough, we also have an oil crisis. So the oil crisis in 3 points pretty much about control. Control because OPEC, which is Saudi Arabia and a bunch of other countries around that, they used to control 55% of the oil production back in the 70s. Now they're down to 43%, but still, they still have a good hand on what's happening on the production. Especially Saudi Arabia, that is the second world largest producer with almost 13% of the production. The rule changed because the United States became the world largest producer not too long ago. I bet it will fall second or third place right now due to the oil crisis. And this is all about this thing. What happened is Saudi Arabia went to the table, put their fist on the table and said, hey, you know what, guys? Let's kill our competitors. Let's play hardball and drop down a ton of oil at cheap price. So basically what they do, and you already know about that, it costs a lot less for OPEC members and even Russia to produce more oil and sell it to super cheap price than it costs to produce oil, either from shale gas and wells in the US or from oil sand in Canada. So basically, if you look at the graph, Saudi Arabia and everybody, they're right here at the very beginning, and then you have like what costs a lot more, which is the US and Canada. The second thing is about the production. It's a lot faster to just open the faucet, start up the pumps as they can do in Arabic countries because they're just basically sitting on liquid oil. So they just pump it up and then put it in the refineries and start making gas or other products right away. It's a bit different for the shale gas. What happened with shale gas and oil sand as well is that it costs a lot to generate a well and a plant that can actually extract oil from the soil. So basically what happened is when it is created, it's easy to operate, but at the moment that the oil price goes down, we have a problem and they stop exploring. So you're going to see in the future, and it's already happening right now because it happened in 2014 the same way, is oil market is down, so CapEx, capital expenditures, meaning budget for exploration, budget for new production, is being cut off. So basically, it's not worth it to invest more money in oil right now, either exploration or production, than there is. So they're just waiting with their money, and they sit and they wait. The problem here is they have lots of debts. OPEC is trying to squeeze them as the market is already squeezing the demand for oil. There's no more demand because people are staying at home, right? So because of all those things together, they're trying to get rid of some players in the US and in Canada. The thing is, you have to understand the difference between dominance and dependence. So the OPEC still have a good control. They're not as dominant as they used to, but the thing is, they are also a lot more dependent on the oil market and their oil production and oil revenues than we are in North America. What happened when they decided to do the same trick in 2014-15? We all expected that Canadian economy would go in recession. It would be the end of the world. And you know what? Customers, client services, they all put the weight of the economy on their shoulders, and we went through it without a sweat. In the US, they kept going. They had a very well diversified market and industry, so they don't depend on oil production to survive and to have a thriving economy. So after a while, the OPEC said, hey, that didn't work out. So they stopped producing like crazy. The price went back up and then it felt better. But right now we're having a lot of problems because we have two crises combined into one. You know, it's like those movies when you have a villain and then at the end of the movie, the villain dies. And then for the second movie, he comes back, but with a vengeance and with his friends, and now they're super powerful. That's pretty much what's happening on the market right now. Now, why I am not concerned so far about the economic impact is the response from central banks and from regular bank actually have been incredibly fast and very, very strong. It's like it is so fast and so strong that the market got scared because they were already cutting down the rates, issuing quantitative easings, and banks in Canada issued a communication this week saying, you know what, if you have problem with your mortgage or any or making your payments on anything with us right now, like for any of your debts, give us a call and we'll find a solution. We'll postpone your payment. We put pause on the amortization, something like that. You'll have a few months to get your things together and then start paying back. But all those things are put in motion. So first, central banks, you know, the rate cuts won't do anything right now. It's not to fight back the virus. What it's going to do is once we're ready for the recovery, and we're not there yet, but once we're ready for the recovery, it will be a lot easier for businesses and for people to get credit and then get back in the economic cycle. The quantitative easing, though, is very important. It's important because it's basically sending money in the market. We have seen what's happening when there's a lack of liquidity on the market. In 2008, 2009, during the crisis, that was one of the worst things. Nobody had confidence and trust in banks anymore, so everybody were keeping their money on their side. So if the money is not flowing, it's like a body. The blood ain't flowing either. Well, you know what? The body dies. So the economy doesn't work. And this is why they're being very proactive right now. They're putting money into the bond market to make sure that they're liquid. I'm pretty sure that you've seen that some bonds went down at one point in time. This is because of lack of liquidity. It was really, really hard to make transactions. Now it's getting better, obviously, because there's more money flowing in. The other thing that they do is the governments, on both sides in North America, they are already taking measures to make sure that people that are not working right now and staying home will get some money. Obviously, they will not be rich out of it, but at least it will help them to keep their house, to continue going to the grocery store and eat and make sure that all their families are fine. And after that, because make no mistakes, the coronavirus is real and it is a threat and it's a tragedy because people die right now, but it's a temporary thing. It's not permanent. So as long as the virus is gone, well, restaurants and retailers and shopping centers are all going to open again, and then people will go back in. So you're not really losing your house, your job right now. You're just temporarily not having one because you can't work. But as soon as it starts again, you'll be able to go back. Now, in terms for banks, now I'm going to talk about Canadian banks and not US banks because it's a bit different system. But in Canada, and actually it's good for US investors because if you're in US right now, your dollar worth so much that it's really worth it for you to consider investing in Canadian banks or Canadian telecom because it's really, really cheap money. So Canadian banks right now, the 6 largest banks, so we're talking about Royal Bank, TD, Bank of Nova Scotia, CIBC, BMO, National Bank, and even for my fellow Québécois, Le Mouvement Desjardins, they all put actions together to make sure that people stay in their house. They have absolutely no intention to get your house back. They don't want your house. They don't want your business. They want to make interest and money out of the loan. So they're not in the business of grabbing like 1,000 houses when it starts again. So what they will do is that they will do everything in their power to make sure that you keep your things and it moves along. And you know what's going to happen if they're having problem? The federal government will back them up. You know why? Because the bank is like the heart of a body. it creates the circulation of the blood. So banks enable liquidity. Liquidity for the market. You have a business, you need a loan, you go to the bank. You have money, you have extra money, you need savings, you go to the bank. It is the heart of the capitalism system. Without banks, we're nothing. So obviously, federal government will back up banks, and especially because right now it's not their fault. They cannot say, oh, you've done bad management, you bought mortgage-backed securities or commercial papers and all those shady products back in 2008 that you didn't really know how to calculate their value. So it's really on you. This time it's not on you. I mean, it's on everybody. We're all getting hit by the virus. So this is why government are printing money, yes, but they are making sure that they take care of what's happening right now. Now, I'm well aware that right now there's two types of investors watching this webinar. The first one, which I would call the growth investor. Growth investors are like me, either in their 30s, their 40s, their 50s. They have a lot of time in front of them. They're still working. They have the ability to put back more capital into the market. So they don't have to worry. They don't have to worry much about what's happening right now, because you know what? Like myself, I'm 38. I will not touch my retirement plan until my retirement investment, until I'm like 60 or 65 or maybe even 70 back then. So I have like 20, 25, 30 years in front of me. I don't really mind what's happening right now. So this is those people, they can focus on dividend growth. They can look at companies that will grow in the future. I'm thinking about sectors that have been hit lately: consumer staples, consumer cyclicals as well. And sorry, I just realized that I made a mistake in my presentation and I'm halfway. So consumer staples and consumer cyclicals, sorry about that. Industrial, banks, quick parentheses. I had to do this presentation maybe like 5 times before today, because the information was moving all like too fast for the past 2 weeks. It was just crazy, and I just realized that I made a mistake. So yeah, what I meant here is consumer, cyclical, industrial, and banks. For income-seeking investors, those are people that are either retired or about to retire, maybe in like 1, 2, 3 years. And now you can feel the fear. You can be concerned about what's happening right now, because you're thinking, well, I'm about to just rely on that portfolio to generate income, and now I'm worried because the value is not there, and companies starts to cut down their dividend. We saw the oil industry going on right away, and then Ford this morning announced that they suspend their dividend, and it's going to be a dark time for those investors, because the volatility is not done yet. So what you can do is, instead of focusing on growth and on what's going to happen in the next 10, 15, 10 years, I know, like, mind you, your life expectancy is likely 85 to 90. So technically, unless you're 75 right now, you still have a lot of times in front of you. And even at 75, technically, you still have 10 years. So you'll live long enough to see the rebound of this market. But I understand, I've been dealing with a lot of clients in my life that were at that age, and just the fact that you have not the ability to generate income again is enough to stress and not sleep well at night, because it depends on what has been saved, and you cannot save more. So this is why it's important to focus on dividend safety. Make sure that the companies you're looking at are showing lower debts, higher cash flow generation, cash reserve. We're talking sometimes about tech companies. The only exception I would do in terms of debt is utilities, because we all need power, and most companies will not close down. Most utilities will not close down because they need to deliver that power to people. I mean, whether the economy is rolling or not, you still need power at your house, you still need water, and so on. So those are safer picks. And this is where I should have wrote consumer staples and not stables. Sorry about that again. All right, so now, which kind of playbook are we looking at? There's a lot of things that you can do right now, some good, some bad, but it depends on your investing strategy. It depends on how you want to invest. A lot of people ask me in the past 2 weeks, hey Mike, everything is on sale. Should we go after falling knives or premium picks? And let me explain. So we're talking falling knives, we're talking about companies that lost 40, 50, 60% of their value, maybe sometimes more if you look at the oil industry. So basically those are going down rapidly. But the problem with falling knives is you try to catch them and you miss, you get your hand on the blade and then you start bleeding as well. So you have to be careful. On the other side, you have premium picks. You have companies like Microsoft, for example, or Visa that haven't been hurt that much. So you're thinking, are they really on sale or not? I was looking at TELUS on the Canadian side, for example. This one also was not hurt that much compared to other companies. And then you're thinking, is it worth it? Well, then again, it depends which type of investors you are. If you are in the growth category, you may want to play with 5 or 10% of your portfolio and then catch some falling knives. There are some methodology to apply. A good example would be with Canadian banks, for example. If you look at the big six, you have the four largest, so Royal Bank, TD, Scotiabank, and CIBC were hit about by 20% at one point. And then you have BMO and National Bank that were down roughly 40%. Now, don't quote me on the 20 and the 40% because every single day it's changing, right? But at one point I look and basically, long story short, smaller banks where we have maybe a little bit less of trust and confidence because they're smaller, they were going down a lot faster than the others. So the idea here is to look at a specific subsector, identify leaders and then losers in this sector, and sometimes you'll be able to pick up falling knives at a cheap price, which are just getting hurt because people panic. And Canadian banks, I think it's a great example. I don't see how BMO and National Bank will get hurt more than the others in terms of what's going to happen with the economy going forward. In fact, I'm a little bit more afraid about CIBC and TD Bank because they're a lot more closer to a classic savings and loans bank. So basically, they really rely on that, while the like Royal Bank, Royal Bank, BMO, and National Bank, they have more emphasis on capital markets or either insurance or BMO with their ETFs. So those are other income streams that TD and CIBC is not as important in their business model. So I would be a little bit more worried about them versus the others. So this is where you can find falling knives. If you're retired right now or about to retire and you look for income, don't chase high yield. A lot of them will get caught. And you know what? It's not because that the stock is going down right now that it's automatically going to back up to January 2020 level. Some will, some won't. You know, we've been riding a bull market for almost 10 years with some fluctuation. Some people forget that we had the flash market crash. Can we say that? 20% down in 2018, and then in 2016, the 15 and 16 market wasn't doing so well, but overall that's been a great ride. And what happened is everything has been brought up to the top. Now we're about to see a lot of those that are being crashed, they're going to stay there. So be careful with that. Maybe go a little bit more with premium picks. In terms of favorite sectors, if you want to go after companies right now, look into the industrials and consumer cyclicals. I'm pretty sure those two sectors have been hit a little bit more. You know, when you think about companies like Disney, for example, this poor company has to close their park. And their park are about, from what I can remember, I think it was like 40% or 50% of their revenue. So basically, it's going to be a very, very bad year this year. But do you really think that Disney World is going to close forever? I don't think so. People will want to go back to those places. They will want to buy apparels. They will want to see Frozen again, and Star Wars and all Marvel super action heroes. They won't stop to go to the movies either. So they will have an after coronavirus for those companies. Now, a lot of people are telling me, oh, is it the right time to play on oil or on gold? You know, those are classics. Oil have been beaten down, so technically it should go back up. So let's put money into oil and it's going to go well. For gold, it's like the opposite. You know, we're thinking, oh, it's panic. People need gold because it's reassuring. So let's buy gold because gold will go up and then we're going to be rich. In those two cases, I am not a fan of those strategies. I'm not saying you cannot do it and you cannot make money. Some people do make money, but a lot of people get burnt. And when I look at gold mining companies, they're not making that much of an impressive return over the past 10 years, even though we had 2 huge crashes. So I'm not super excited about them. I'm a lot more excited about dividend growth stocks. A lot of people talk also about leverage strategies. So here we're talking about people borrowing money to invest even more in the stock market because it's trading at a cheap price. On that, I'd say that for the first 4 years of my career, I was doing investment loans. So basically between 2003 and 2008, and I kind of like switched it to become a financial planner at the end of 2007, beginning of 2008. So I left the investment loan place at the perfect timing, I would say. But what I've learned here is, if you want to do leverage, if you want to borrow to invest in the stock market, you need time. So don't expect your money back next week or next year in 2 years. You need like at least 10 years in the market to make sure it works. Then you need to have lots of liquidity. So you have to make sure that you're able to stomach losses in the meantime, that you actually can pay back that loan at any time without your investment. So you need to be able to support that debt. And 3, you need to be able to stomach fluctuations. Because imagine that you borrow $100,000 today, you put that in the market, and next week it's down at $80,000. So you already owe 100, and then you're under by 20 more. So you're back at paying back everybody $120,000. That's a lot of money, right? So you don't want to go there if you cannot stomach short-term fluctuation. Finally, in terms of tops, should you use stop sell or just sell right away and then wait? I'm staying 100% invested in the market, and I don't use stop sell. First, if you want to do stop sell, you better off just sell everything and then never come back again. In 2008, while I was a financial planner, I told all my clients, and I was working downtown Montreal at that time, and then I was calling my clients. I was not waiting for them to call me. I was calling them, and then they were just like, oh Mike, it's crazy. We're going to lose everything. 90% of our portfolio is going to go down the toilet. I don't want that. I can't sleep at night. I want to sell everything, go back to bonds or money market funds or whatever. Just get me out. And I'm like, yeah, sure. Let's take an appointment in 15 minutes. All the documents will be ready to sign. So you're going to come down to my office. You're going to sign that. And then we're going to put all your money into bonds or money market or whatever makes you feel safe. And then you're going to call another financial advisor, because I am not going to do anything anymore for you. And most people were shocked. They're just like, oh, you don't want me to get my money? I'm like, no, sure. Like I'm already working on the paperwork. You're going to get your money right away. But once you do that, you just prove that you're not made to invest. You're not made emotionally, psychologically, you're not strong enough to support that. And you know what? The best investing solution is always the one that helps you sleep well at night. And if you can't invest in the stock market, I cannot help you. So you're better off just putting everything in bonds. But don't come back in a year or in 2 years or in 3 years when things will be settling down, or it will be more normal, or whatever wording that you can say. I've heard that all the time. Oh, I'm getting out, but I'm going to come back when things are better or normal. Well, you know what? When you do this, and all the research show this exactly the same thing. When you do this, you usually miss a good part of the growth that came from the bottom, because you know it's not like the stock market's going to go like this and then it's going to go like that, right? It's going to go like this all the time, and then one day you realize you're up there, and oh, there's the market was up now 30%, And now it's time to go back in the market. Well, you just lose it. So right now it's not too late. If you want to get out, just get out and that's it. You're going to be fine. You have to take your loss, but most of the loss is what you made over the past 2 years because we had a great year in 2019. Now let's talk about recovery time. What you see here is the S&P 500 total return, so that includes dividend, from 1990 to 2020. So basically 30 years of history. And as you can see, we had lots of drawback there, lots of fluctuation. And besides the tech bubble, which took about 6 years to recover, most of them are very fast. In fact, history tells us, even if you go back in time, history will tell you that in general, a bear market will take roughly 18 to 24 months to recover. Sometimes it happens like the tech bubble or the financial crisis. It takes a little bit more than that. But even then, you remember, please go back in time 10 years ago, well, 12 years ago. And remember, in 2008, it was the end of capitalism. The oil market, the oil barrel will never go back up $35. It will stay there forever. We're going to lose our house. Banks won't exist anymore. Basically, pretty much get yourself a dog and a shotgun because we're now in The Walking Dead. That didn't happen. It took 4 years. Actually, for like the worst financial crisis in the world, it took 4 years to recover. And do you know why? Because the human being is incredible. We have almost a magical gift inside of us. We are able to adapt. We find solutions when there's none. So what's going to happen with the coronavirus is exactly the same thing that happens like a million times in the history of the human. We're going to find solution. We're going to find back. We're going to adapt, evolve, and thrive. And this will happen again this time. Now, what you should do. This is where I'm a bit biased because I am always focusing on dividend growth investment, but this is what I believe in, and I'll show you in the next slide why I believe it so much. So basically, your investment plan should be based on dividend growth and not the value of your portfolio. So it is still time right now to look at your portfolio. Make sure that you're invested in the right sectors that we have discussed in this webinar, whether you are a growth investor or if you're focused on income. Revise investment thesis for each of your holding. Identify the likelihood of a dividend cut for each company and then replace weaker stocks with stronger one. Yesterday, I did a private webinar for my DSR members, and that was a question that came back a lot because we use a DSR Pro rating. So basically we're telling you which stock is good, which stock is bad. And then we're also giving a dividend safety score. So which one is likely to cut their dividend or likely to increase it. And lots of people were saying, well, should I right now get rid of my losers or get rid of some mutual funds that I don't believe in anymore and invest back into stocks that have a stronger rating? And the answer is yes. Whether or not you're part of DSR, whether or not you use those kind of tools, if you sell your bad stocks and you buy new ones that have better metrics, you're staying invested. A lot of people are saying, oh, when there's a crisis, don't sell, don't sell. Well, don't sell and get out of the market, but you're allowed to sell and then reinvest back into a better company. That is just making sense. So this is why right now it is the time to look at your portfolio and don't look at how much you made or how much you lost. That is completely irrelevant. Look at the company. Revise your sector, your investment thesis, determine if there's a likelihood of a dividend cut or not, and then replace those weak stocks by better ones. Now, why the DSR investing model is all about dividend growth. What you see here is a study, funny enough, made by Vanguard. And you know Vanguards are selling ETFs. They're not selling dividend growth stocks, right? And from 1997 to 2016, so basically we had the tech bubble, and we had and we had the financial crisis. So we have two crises in there. As you remember, 2 slides ago, those were the two most violent and most painful recession that we had in stock market, bear stock market that we had over the past 30 years. Well, during that time, dividend growth stocks outperformed the market and did it with less volatility. So this means that you're making more money with less stress. That sounds like a pretty good deal. And when I look at my personal portfolio, I can tell you that it's kind of funny. When I quit the bank, I quit my job as a private banker in 2017. When I came back from my trip, I officially quit and say, you know what, I'm going to spend all the time on Dividend Stocks Rocks to build that business because I believe in it. I received the pension plan, the community value of my pension plan. So I received a check of $108,000, which I invested. It was transformed in a Libra account. So basically it's a locked-in account for my retirement. I cannot put more money into it, and it's tax sheltered. So the $108,000 was locked there. I started investing at the end of 2017. So I got the check around September, and by December, I had the full amount invested in dividend growth stocks, part in Canadian, part in the American markets. In 2018, at the bottom, I look at how much I had. And then over the past 3-4 weeks, I was looking at that value and compared it to what's happening right now. And I never hit my 2018 bottom yet. So basically, yes, I'm still taking a hit. My portfolio is down, but not by that much. I'm not even at 2018 yet. And you know, it goes up, it goes down. Maybe that by the time that you watch this portfolio, I'll be under. But so far, so good, because it is a little bit less volatile than the rest of the market. Obviously, I have a very small position in the oil industry. I'm not a fan on this one. I've never been. Most energy stocks at DSR were rated as sell last year, not this year, last year in 2019. So basically, just to tell you that the model works, and even Vanguard proved it. Now, what can DSR do for you? First, we have our ratings that we just talked about. We revisited them considering what's happening right now, and considering that we enter in a recession. It's not official yet because a recession needs 2 consecutive quarters with negative economic growth, negative GDP. Well, we all know it's happening, but we'll need 6 months to confirm that we're in a recession, but we are. So we have revised that, thinking of what's going to happen with those companies. We have daily data updates. So when you go on each stock analysis, all the data, so all the financial metrics, and we have tons of them. They're all updated daily. So every day you trade on accurate information. The information changes fast, but I refuse to overload you. I refuse to create more noise. So what you'll get is a weekly newsletter as a guide. You feel confused, you feel afraid, you are concerned, you're looking for buy tips or buy ideas, you're gonna find everything in the newsletter. It will be your guide to stick to your plan, ignore the noise, and on top of that, make strong buys. And ask any DSR members, and usually they are here to comment on that. Today they're not, because it's not a live presentation, damn it. But they will tell you that it works. They've been with us for several years now. Lots of them have been pro members as well, and they just love it. So today I want to invite you to come join this community for $97 a year. The regular price is $177. I'm offering you a 45% discount, and you can join and you will keep that price forever. So basically, the DSR community will be about getting a clear strategy, concise information, and actionable tools. In the email I just sent you, I will send you the link. Basically, the link is quite easy. It's dividendstocksrock.com/webinar-promo. You go there and you have the choice between paying in Canadian dollars or US. It's $97 anyway, because I am Canadian and I would be upset to pay in US dollars right now. And you know what? If you're American and you want to have a very cheap price, well, pay in Canadian, but don't ask me about the currency exchange rate fees on your credit card. I'm not responsible for that. But basically, you have the ability to pay either in Canadian, either in US, And if you feel unsafe about your portfolio and you're unsure about what's going on right now, we also offer you to review your portfolio. This is called the DSR Pro service. At the bottom of the page, you'll have a video and an example of a DSR Pro report. So basically, 4 times a year after each earnings season, and you're very lucky because we're closing in the earnings season right now. So this means that if you register today, you'll get your portfolio before April 10th. That's for sure. You'll get your portfolio review before April 10th. We review all your dividend paying stocks. We tell you what's happening with them. We rate them for you, and we point where you should put your attention. So basically, it's an all-in-one service that we do the hard work of following, reading the press release, analyzing what's happening, determining if it's good or not. We do all the work for you, and then we give it to you right away. This costs $197 a year, so basically $200 a year, $50 per report. You get access to all the DSR features, which are DSR portfolio models, stock cards analysis, private webinars. If you have enjoyed this webinar, they already had 2 webinars over the past 10 days. I had one last week, I had one yesterday, and I'm going to do another one tomorrow. And finally, the newsletter. Tomorrow on Friday, they will receive my list of dividend safety picks per sector. So basically, we reviewed every single sectors. We identified where you should put your money if you're looking for companies that will stick to the ground and pay their dividend. So I hope that you have enjoyed the webinar. Once again, I'm sorry for the technical difficulties. I feel sad that I cannot answer your question because this is the best part of the webinar is the Q&A session. I'll do one Ask Me Anything webinar next week, that is for sure, so don't forget about that. And please go to DSR right now, dividendstocksrock.com /webinar-promo, register, take a look around. You have 60 days to ask for a refund. So for once in your life, you have the opportunity to make a risk-free investment that will actually be worth a lot more than your $97. So see you at DSR or see you at the next webinar next week. And in the meantime, stay invested. Cheers.